So good afternoon, everyone. Good evening, perhaps to a few of you. We're very, very pleased that you could join us today for our webinar on current economic challenges, the monetary policy, fiscal policy mix needed at this stage of the COVID crisis. My name's Patricia Mosser. For those of you who don't know me, I'm the director of the MPA in Economic Policy Management program here at Columbia SIPA, and I also direct the school's initiative on central banking. I'm really pleased to moderate this afternoon. This webinar is incredibly timely and topical, particularly for those of us sitting here in the United States, where yet another large fiscal package was on infrastructure spending was just signed and put into law yesterday. As we all know, though, the monetary and fiscal policy responses to the COVID pandemic and the subsequent economic crisis have been nothing short of extraordinary in their size, in their speed, in their scope. And so we're really lucky today to have four of SIPA's own faculty experts to bring their perspectives, both to assess sort of the impact and the effectiveness of the COVID policy responses to date, and also to point out future risks and challenges for policymakers, not only in the advanced economies, but in emerging and developing economies as well. I want to keep the introductions real short so we can get right to the substance. Our first speaker is Jack Lew, visiting professor at SIPA, former U.S. Secretary of the Treasury, White House Chief of Staff, and the former Director of the U.S. Office of Management and Budget, who will start us off. He'll be followed by SIPA Professor Takatoshi Ito, a former Dean at the University of Tokyo, as well as former senior policymaker at both the IMF and at Japan's Ministry of Finance. Next, we'll be visiting Professor Willem Buiter, who was a former chief economist at Citigroup and a former member of the Monetary Policy Committee at the Bank of England, and he's going to focus on global consequences. And last and not least will be Professor Guillermo Calvo, who's going to focus on risks to emerging markets, most particularly inflation risks. As to format, everybody's going to give a few minutes of opening remarks and comments, and then we'll move to questions. Please use the Q&A button at the bottom of your screen to ask any questions you would like. I cannot guarantee that I will get to all of them, but the sooner you send them in and the sooner I see them, the easier it will be for me to look through them and pose them to the panelists when we get there. You can enter questions anytime during the discussion. You don't have to wait until the end. And with that, as an introduction, I'm happy to turn it over to Jack Lew.
Thanks so much, Trish. Just had to unmute. It's great to be with you all today, and good to see my friends and colleagues, if on a screen. And I'm going to start taking an overview of where we are coming out of the COVID crisis, and then drill down a bit on the United States. I think it's fair to say that we're beginning to feel a bit better as vaccinations continue to spread both in the United States and around the world. But I think even just the news of the last weeks has to remind us we're not through this yet. And fundamentally, the course of the recovery from COVID is going to track the nature of the disease as it continues to evolve and as we continue to learn how to deal with it. To me, as a former policymaker, what it says above all is we have to maintain our humility about understanding what we know and what we don't know. And as we evaluate the responses early in the pandemic, the uncertainty was vast. Candidly, as we approach the second anniversary, what we don't know is still competing with what we do know in terms of what the shape of the problem that we most need to worry about is. I think for policymakers, and it's certainly true in the United States, but I think it's true around the world, there's a tension between the different risks that we face in terms of making sure there's a robust recovery from a global health and economic crisis, and at the same time worrying or keeping an eye on inflation to make sure we don't unleash forces that we can't later control. I must say, as I watch the debate in the United States in particular, but in other countries as well, I worry that the kind of fundamental advice that I would always offer to the most senior policymakers: don't overreact to any one piece of data. Wait until you see a trend. Understand what you're doing as best you can. Seems to be in some ways overwhelmed by the day-to-day instantaneous news coverage of the inflation phenomenon that we're seeing. In the United States, it's typified by a fixation on gasoline prices, where as the price of gasoline per gallon hits or exceeds $5 a gallon, near panic sets into discussions about inflation. I think it's safe to say that because of the robust response to the crisis in the United States, in Europe, in China, in Japan, though Taka will have much more to say about that, the quality of the response has led to a recovery, though the recovery has been a bit uneven because as waves of the disease have recurred, there have been volatile economic signs that question how durable the recovery is. And to some extent, we'll hit a point where we plateau, and the combination of vaccination and treatment will allow us to say we're beyond that. But I don't think we're yet truly beyond it. You look at supply chain problems. Just this week, reports out of Vietnam about a reluctance to go to the workplace in Vietnam because of fear of infection. Well, the supply chain globally is very much affected by what happens in the factories and workplaces in Vietnam and many other countries that have low vaccination rates. I think if you compare the responses in different economies, the United States did respond at the height of COVID with a significant fiscal and monetary effort, and it sustained that effort. I think that's led us to a place where, as we'll hear in some of the remarks that some of my colleagues will make, a stronger economic path in the United States. It's also increased the pressures of inflation in the United States. And I think you have to unpack a little bit what's happening, both in terms of the inflation impact and what that means in terms of the decision points that policymakers face. Fundamentally, the inflation driver, I believe, is a supply chain problem, that the economy in the world shut down. We have backups in both production and shipping. They're going to take the better part of 2 years to resolve. And that means whatever we mean by temporary and transitory has a different meaning than when the response time is a week or a month. So to me, passing through over the period of 18 months to 2 years is still transitory. The question is, what are you left with in terms of growth inflation at the end of the transition period? I think that there's a lot of evidence that core inflation is picking up. There's not a lot of evidence that core inflation is approaching anything near hyperinflation levels. So if you kind of say before COVID, the challenge was, how do you avoid having a period of secular stagnation where hitting 2% inflation would be hard? We're going to come out of COVID probably with inflation somewhere between 2 and 3% in the United States after the dust settles. And the question will be, how long does it take to get back to 2? It's a separate debate how critical it is to get from wherever it ends up back to 2. I think we hope we'll talk about that a bit, because my own view is there ought to be a little flexibility about the 2. It's not a divine law. And if the trade-off is a healthy economy that offers better wages and work opportunities and reduces some of the inequalities in the economy versus a fraction of a percent of inflation, I know what my choice would be as a policymaker. I think you also have to separate out some of the secular trends from the immediate response to COVID. And the thing I look at as kind of an indicator of this is, look at trucking in the United States. I think this is true in other countries as well, and my colleagues may have a better sense of that than I do. You had an aging workforce. You had rules of the workplace that were changing, I think for the better, to make it more difficult to stay up late at night, because you could be tested to see if you were sleeping in the truck. You could be tested to see if you had been drinking or using drugs. The lifestyle changed. The age of the population meant people were going to be retiring. It became a less attractive profession for young people to go into before COVID, dramatically so when the alternate work opportunities in the United States, working without spending nights away from home, gave you comparable or better wages working in a big box shipping center. That's not, to me, a question of wage inflation caused by COVID response. If you come out of COVID and you have to ask the question, what's the structure of what are we paying people to do work like trucking to get people to be willing to stay away overnight? Let me close with just a minute on the fiscal policy and monetary policy of the United States. I'm sure we'll come back to this. Yesterday, President Biden signed into law over $1 trillion of infrastructure spending. Importantly, more than half of that is old spending. So it's actually only half an increase to the amount of spending that's in the system already. That is going to be spent over a number of years because the idea is to build strategic infrastructure, not just to move money quickly, because we're beyond that in terms of the need for it at the moment. I don't worry about the inflationary impact of that bill. There's another piece of legislation moving through called Build Back Better that's going to have some amount of spending, call it $1.5 trillion to $2 trillion. As the dust settles, we'll know what the number is. That also is multi-year spending, but importantly, it's paid for, and I think before it's enacted into law, it will be paid for in a way that people can have confidence in. There's noise now about what the estimates of offsets are. What matters is at the end of the day, is there an agreement that it's largely paid for? I think those investments, if largely paid for, will have modest impact on inflation because, again, it's multi-year spending. It's not coming into the economy all at once. I think in contrast, savings went way up during COVID. There's anywhere from $2 to $3 trillion of savings built up in the economy. That's there right now for people to draw on. That's much more of a factor in terms of current demand for goods and services. As people come back into normal service consumption, I think there will be moderating pressure on prices for tangible goods. But I think there is going to be this inflationary push because people were saving money during COVID because they weren't going out spending and they had their income sustained by fiscal programs to enable that. I think the Fed is going to have to deal with that challenge in the short run as they decide when to take off from tapering to rate increases. But I would be shocked if they'd make that move until they get the sense that the risk of inflation is sufficiently high that it's worth starting a process that could end up slowing growth prematurely. And I think they'll move gradually so that they get a chance to see how the data is settling in and what the impact is. And I think if you're talking about inflation rates where you're worried about a 1% to 2% increase in inflation, it's a very different need for acting prematurely or too quickly than if you were talking about something that was already spiraling. I'll stop there. I went on a little too long and pass it back to you, Trish.
Thank you, Jack. So next is Takatoshi Ito, please.
Thank you very much. And I'm Takatoshi Ito, teaching at SIPA. And today I will going to give you some facts on the COVID infections and death in both in the United States and Japan, review the fiscal responses and monetary responses, and that would be a I will do that. Okay, so this should do it. Okay, so I will argue that it was infections and deaths were much lower in Japan, but what happened in Japan was that infections surge in 2021 this year was much worse comparative to US, and that cost the political leader. And vaccination started late in Japan, but accelerated very quickly and overtook US in September. And this has political implications on how the COVID is received by the public. And the monetary responses, fiscal responses, very fast in the beginning of the COVID crisis. But monetary responses plateaued, and some of them are already terminated, while fiscal is still going on. And question is, how much and enough or misdirected. And I will give you some of my views on how things are going in Japan. At the end, we measure how successful the policy has been by sort of economic recovery process. And it is much slower in Japan this year compared to the US because I think it is affected by the COVID infection surge in Japan. So there's a trade-off between economic recovery and infections, the restrictions on the movements. Okay, so there's one stark difference between Japan and US in terms of how to stop the businesses to go fail and workers to be unemployed. And Japan put much more subsidies and money into businesses, not to fire workers. So at the end, that unemployment rate surge in Japan was very limited, while US, as you know, the unemployment rate went up very fast. However, they were helped by the increased unemployment benefits. So there are two different ways to help the businesses and workers. So the last I will talk about how to prepare for the new normal and whether fiscal spending is helping those transition to new normal. So that's the line of my talk, and if time runs out, I'll stop in the middle. Okay, so. So this shows the Japanese infection number versus US infection number, 7-day average. And the scale is 1/10 in Japan. So when the line agrees, that means the infection number in Japan is 1/10 of the US. So look at the 2020, which is the left half. US had much more infections, so it is like 1/60th in Japan. What is interesting is that there is a high correlation in the surges, but the relative magnitude has been different. So my point is that in 2021, that is right-hand side of the chart, that Japan in relative to the US has become much higher, especially the one in the summer, and infection, spiked at the last week of August, which is, just after the Olympic Games. But the number quickly came down, and it's almost zero. Actually, it's like 200 right now in Japan. So there is great debate in Japan why it spiked like this way, and experts cannot explain why it declined so much quickly. Okay, so the next slide 6, this is the cumulative death number. And again, in 2020, the left half, the Japan was much lower compared to the US. So scale is like 1/40th. So it used to be 1/100th in Japan. Now its line agrees, which means Japan cumulative death is 1/40th of the US. Population difference is like 2.5 times in the US compared to Japan. So even if you account for the population difference, that Japan is still low. Okay, next slide. This is the OECD ranking of the vaccination. And this is back in June 5th, 5 months ago. And the US is quite ahead. That's number 5 after the Israel, Chile, UK, and Hungary. Japan was dead last among the OECD countries 5 months ago. The next slide shows now. So now Japan is in the top 10, and US is in the bottom 6 or 7. This is the remarkable acceleration in Japan, although it started late, which means that there was a lot of death due to late vaccination. Okay, next, please. So this is actually vaccination per 100 people in the time series. So Japan was quite behind until the mid-June and accelerated, did not slow down, and overtook US in mid-September. So all this infections and vaccinations has a lot of impacts on the economy and politics. Okay, so fiscal policy is the next one, and so US is among the top in spending and tax cut and so on. So it amounts to 25.5% of GDP, and this is according to IMF, and Japan is 16.7%. But in loan guarantees and equity purchases and so on, Japan is much higher, and US almost nothing. So contents of fiscal stimulus are slightly different between US and Japan, but both countries, along with other advanced countries, spend a lot in fiscal policy. So next slide, please. So this is the IMF, I borrowed from IMF, that US and Japan spend a lot, and advanced countries spend a lot. And compared to smaller countries, this is in percentage of GDP. Okay, next, we're going to talk a little bit about monetary policy. So I'm going to skip this slide 16 and 17 and just show you next graph, which is balance sheet expansion of the central banks. And this started from global financial crisis. And then you just look at the US, the global financial crisis, the balance sheet was doubled in a very short period. And QE continued to 2014, then tapering and actually declined a little bit before the COVID struck the US. And again, the balance sheet expanded very quickly to very high level. Now the balance sheet is about 10 times of what used to be in 2007. BOJ is also expanded very quickly, and so is ECB and BOE. So monetary policy responses are in terms of the asset purchases and targeted liquidity provisions and supporting some of the particular markets. But it is now, I think, not playing a very large role at this moment. Okay, next please. So Japanese recovery is very slow compared to US, which I will show you the graph. And reason I thought about it, and maybe fiscal expenditures were misdirected. And it's not, for example, the cash transfer, the cash payments to all the citizens in Japan was done last year, but there is no income test, in contrast to the United States. So of course, the rich people get those cash transfer; they just go saving. So it didn't help the consumption. Actually, consumption activities are restricted by the COVID situation. So fiscal, cash transfer doesn't actually help in terms of supporting the aggregate demand. So next graph, please. So this is the GDP level with 2019 fourth quarter as 100. Both countries saw the drop by 10% compared to the peak, then recovered. So US, you see the blue line has steady increase, and I think it's getting back to pre-COVID, surpassed the pre-COVID peak. Now Japan recovered quickly last year because their infections are so low that people started to do activity. But 2021, this year, since the infections became worse and worse, that they stopped actually do the activity, which shows in this GDP recovery. Actually, it's declining in the last third quarter. So reflecting that, you remember that sharp spike of the infections in August. Okay, so I think I'm running out of time, so I'm going to skip this label for holding. I already explained. So there's a sharp, there's not much increase in unemployment rate in Japan, while in the US there was a big spike, but came down very quickly. Okay, so new normal. What is new normal? New normal is that we are getting out of this COVID, maybe thanks to the vaccinations, maybe thanks to the people's behavior change, and many things went to remote, like this webinar, that remote teaching, remote work, remote conferencing, and medical services, shopping, and so on. So will these remote activities stay after COVID situations become controlled? And if that's the case, then we have to prepare for those remote activities, and fiscal spending should go that way instead of helping the declining industries because of this shift to the remote. Maybe airlines have to cut back some of the services because we are not flying like before. Okay, so the last slide, please. We means that governments should stop fighting the last war, and cash payment doesn't work, and we should stop subsidizing declining industries. And this slide message is for the Japanese government. Thank you.
Thank you, Taka. Willem.
Thank you. Let me try and see whether I can share screen. Okay, does this work? Okay.
Yes.
The global economy has essentially recovered from the very sharp, deep recession we had for a couple of quarters in 2020. If you look at world growth, minus 3.1 in 2020, 2021, 5.9%. We're basically, by the end of the year, globally back where we were expected to be before COVID hit. The last line, world trade figures, tell a very similar story. It's not been even. I mean, the US didn't go down as far as Europe, and it's recovering somewhat faster. Japan is underperforming, I think, quite significantly. It had just had another quarter, the third quarter of negative growth of this year. Emerging markets and especially low-income developing countries were less impacted on average by the COVID crisis and have continued to grow except for the disappointing rate in low-income developing countries, at quite a sustainable rate. I think India is an interesting case. Among emerging markets, they're among the hardest hit with some Latin American countries. Latin America has underperformed in the recovery quite badly, but India is bouncing back very smartly at a rate of 9.5%. And again, China didn't even have negative growth. So effectively, for the world as a whole, monetary and fiscal stimulus, counter-cyclical, delivered what it was supposed to do. It is time in most of the advanced economies and the stronger emerging markets to end monetary fiscal stimulus. In the US especially, given the damage done to the supply side of the economy by COVID, that will be permanent, right? The US is, I think, at capacity now. And the EU is close to getting there. Japan, I think, is still some distance away because of its disappointing recovery and may not achieve full capacity utilization until the end of 2022. And more supportive fiscal policy and monetary policy that purchases any additional sovereign debt to be issued makes sense there. We have okay, let me just get on. Advanced economy inflation is not transitory. Base effects have worked out, they're gone. There still are some temporary COVID-related negative supply shocks through labor supply and supply chain that contribute to the transitory component of inflation, but the bulk of the inflation we're seeing simply reflects an output gap that is becoming increasingly positive, especially in the US. You see the inflation rate on the CPI in the US at 6.2% in October. Even the core PCE deflator is at 3.6%. Right? That's way above target. So why are the monetary policy authorities not responding? A strange issue, I can't address that at length here, is why monetary policy authorities, when they talk about monetary tightening, always order it to have the QE departure or the asset purchases diminished first before they raise rates. There is no argument in economics why you can't raise, why you still raise rates, why you're still expanding your balance sheet. So I would in fact recommend, certainly for the US, which I think is suffering from now persistent excess inflation, to raise rates right away. The neutral policy rate can't be less than 2.5%, and so we've got some way to go. The euro area is slightly less acute than the US, but I think they should be raising rates by the middle of next year, as should the UK, although they may in fact do so earlier. Japan, I think, because of its undershooting, continued undershooting of the inflation target and its disappointing recovery, could have additional monetary fiscal stimulus. But financial stability is going to be a major issue in years to come. Risk assets, I think globally, both real estate and equity and debt are excessively generously priced. Yes, I know that the low risk-free neutral real rate supports high asset valuations, but the profit projections, including growth of residential rentals projections, are excessively optimistic, and risk premia are, in my view, dangerously low. It's a clear bubble. Balance sheets, both in the private sector and the public sector, are dangerously overstretched. So advanced economy central banks will likely to have to engage in lender of last resort and market maker of last resort operations at the same time that they might be raising policy rates because of inflationary conditions. So, external debt for many emerging markets and low-income developing countries is at unsustainable levels. And we are going to see material sovereign and indeed private debt, but I focus on the sovereign here, debt restructuring starting next year and continuing for the next few years. The external debt of low-income countries rose by 860 billion in 2020. Right? External debt of low and middle income countries rose to 8.7 trillion. The sustainability ratios, debt to gross national income, excluding China, right, rose to 42% and 37%. And the debt, external debt to exports ratios, again including China, is now at 154% for middle income and low middle income countries. So the COVID pandemic will continue to hurt many emerging markets and low income developing countries more than advanced economies in 2020 and beyond, because of lower vaccination rates and because we are going to see a major relocation of pre-COVID global supply chain to locations closer to the final consumer. So emerging markets will lose some of their production attractiveness. Debt forgiveness, as I said, will be required on a significant scale. And since much of the debt that has to be restructured is non-Paris Club debt as privately held, we must think of mechanisms for getting an orderly debt restructuring for privately held sovereign debt of the kind that we like to see in years to come. Significant additional financial aid will be required, I think, to manage the COVID legacy, in addition to the longer-term financial support required to support the effective pursuit of the Paris Agreement. Right? And as usual, the advanced economies are falling short. They agreed in 2009 to deliver 100 billion a year for green purposes to low-income developing countries. They haven't come close to this required. And the SDR allocation, 650 billion, extraordinary number by historical standards in August 2021. Well, it's nice, but low-income developing countries receive 21 billion of that. And we are hoping that some of the richer recipients of the SDR allocation will pass it on through a variety of mechanisms to emerging markets. We will need, I think, to see, since we are going to see financial stress in many emerging markets and developing countries as monetary policy is tightened in the advanced economies, as it has to be for domestic policy reasons, we should see the extension of US dollar liquidity swap lines to many more emerging markets and low-income developing country central banks. And I also would like to see the FEMA repo facility extended to many more emerging markets and low-income developing country central banks. We are going to have to deal with financial stability issues in a number of emerging markets and low-income developing countries. In the longer term, I think we need, in the advanced economies, as well as in emerging markets, we need supply-side policies, fiscal and regulatory, to address the longer-term COVID pandemic consequences and climate change. Infrastructure investment, complementary public and subsidized private investment in a more diversified and resilient supply chains, public investment in climate change targeting R&D, global target taxes, the end of subsidies for fossil fuels, and then various rules and regulations aimed at serving climate change and biodiversity issues. These budgetary measures that are required should, for the future, be balanced budget or even budget surplus oriented. Public debt in many countries is dangerously high. It's only sustainable because interest rates are extraordinarily low and is expected to remain that way in the medium term. End of story. Thank you.
I guess emerging markets were mentioned several times in these presentations, and my initial remarks today will be focused on those countries. I agree with Willem that emerging markets could be in serious trouble. And I guess my emphasis here, however, will be more on the lender of last resort facilities that emerging markets may need, which is connected, for example, to a sudden stop episode. So not that the other issues are not important, but for emerging markets, we've seen them in practice in the 1990s, and the question is, will they come back? And the policy followed by the US and particularly another emerging market, advanced economies, whether that could activate that channel. Okay, so this kind of summarizes the history, the relationship, because lender of last resort for emerging markets is not the local central bank. You need the international predisposition to help very quickly and big ways sometimes. So we have two types of experiences and this connection. One that I characterize as pessimistic, which we saw with the Volcker shock that generated a so-called lost decade for developed countries and emerging countries, emerging economies. And then the Russian crisis that did not start in the US, but it had repercussions in the US through the LTCM and so on. And the Fed, when I write Fed, I mean all the global central banks, but in this case, particularly the Fed, had to resolve, but not under the perspective that the Fed, in this case, the US, given that the crisis has started or was related there, had any responsibility or big responsibility to the rest of the world, which is the way the Fed works and is perfectly natural. But this was felt as a kind of domestic problem that would not come back through the rest of the world. So what happened, this is very interesting episode that I really recommend to keep in mind, because practically all the emerging markets were involved, even though the crisis did not start there. Even though you have a lender of last resort in the US, it spreads all over the world of emerging markets. And it's the longest recession that we have since 1990s. So this is the pessimistic one. And I highlight this one because I fear that this might happen. These countries' emerging markets are very, very weak in this connection because they don't have any kind of global money that they can resort to by themselves without depending on international lending to resolve this kind of situation. Now, the optimistic situation or crisis, if you wish, is a Lehman global financial crisis, where the Fed, because they felt that if they didn't do something to stop that crisis, it would come back to haunt them, was super active. And that combined with China's superannuation policies engineered a short and moderate recession in emerging markets. So that's a good scenario. The other one is the COVID that so far has helped a lot. Actually, immediately after the crisis started, we saw the Fed in particular doing all kinds, and we have discussed that, all kinds of subsidies or efforts to restore normality. So far so good. The question is whether the present situation where the US is in trouble in particular, whether the US is not going to be perhaps excessively focusing on its own problems and leave the rest of the world momentarily at least alone. I have a problem because I need to do something about, oh, there we are. So just very briefly, here you see what happened in the Russia crisis. And this is the MB, the sovereign spreads. This is an average for all the emerging countries. It's not one country. And so you see that the moment what I call the Russian crisis starts, the spread goes over, it's more than 15%. On the right-hand side, you see it's in basis points. So this is 15% out of the blue coming from 5%. So that's important to keep in mind because that's the sort of problems that you have in emerging market. Maybe they have outgrown this, I hope, but you cannot ignore it. So you see how quickly it went up. And there was, during this period, no lender, big lender of last resort help. And as a result, this took about 5 years to go back where it started. So conjectures that you can make, one is tempted to make in this connection. Well, Fed tightening this time is not going to be like Volcker shock. That's out of any possible reasonable imagination. So that wouldn't be a problem. However, as I'm going to show, I mean, Willem has mentioned the fiscal deficits in emerging markets are still there. They have this deficit have been financed partly by seniorage from the countries themselves, something very unexpected. But will it last? And so if fiscal deficits were to continue, they would have to resort either to seniorage again or debt. And the situation would have to be reversed. So one solution is more external funding, of course, but it's not easy under the present circumstances. All domestics are the stop. This is what worries me. I think we cannot discount that. Even in countries that, remember the episodes of Sudden Stop are interesting because they involve countries that have done a very good job. I mean, it's not that they were crazy with crazy fiscal deficits. Even the good ones in East Asia, for example, were hit during the 90s, which was a surprise. And the reason is that the key factors are financial and liquidity. Now you see that curiously, this is very unprecedented. During the COVID crisis, the M1 over CPI, real monetary balances, for this bunch of countries, but I can increase the number of countries and you will have basically the same result, is a very large increase, like in the United States, even though these are emerging markets, in the holding of money. So maybe possibilities, precautionary motive, I don't know, but it's quite possible that this, in order for this to continue helping these countries. At the very least, one should expect that this will not fall. But if there's a sense of going back to normality, this amount of additional money could go back to the market, to haunt the market. Fiscal balance, according to the IMF, you see, and this is a point that also Willem has mentioned, emerging markets in the 2020s were about 10% of GDP. This is expected to go down, but still very large. So this financial tension is there. You don't have money to throw into the market like Japan and the US. And so what happens? My summary is that there are very few options if that sort of thing comes to haunt us, okay? So I feel that that the situation, if it gets to the point of creating sudden stops, and you have to believe that that could be the case, because remember when COVID started, there was a mountain of money that went, capital that went out of the emerging markets. And then the moment that the US showed a policy, very expansive monetary policy, just the announcement itself provoked a reversal of the flow. So it depends very much on how the market thinks the central economies are going to be willing and able to help out the emerging market. So it is possible, if we are not careful, and with that I agree fully with Willem, that there is this bad scenario, and if it repeats itself, nothing repeats in this business, but in any case, remember that this lasted 5 years to go back to normal. So my hunch is that I don't expect global central banks largesse like we saw in the great financial crisis and the COVID. Why? Because in these two crises, advanced economies were heavily involved too. So they were doing something for themselves. And sometimes what happens is spill over. I think part of this is spilling over to emerging markets, giving support in terms of international reserves because of the fear, the concern that the treasury market would become very unstable. Now, my advice for emerging markets is that don't expect this. I hope it works. But if not, I mean, you are in these scenarios where it's very easy to make major crisis mistakes. So this is a time where it's very important, because we've seen the mistakes in emerging markets. And even if you do everything right, it's likely to be costly, because this is a time where time inconsistent policies are very tempting. And when you do that, then you compromise future policy credibility. This was my original presentation, but let me add just one more slide and a comment related to that. Now going back to advanced economies, this is M2 over GDP for the US. And as everybody knows, there was a big expansion, monetary expansion from here to here to the beginning of the COVID. And even more impressive is what happened right after the COVID starts, right? So somebody could make the mistake of believing that if inflation did not arise here, why would it arise here? Well, very simple comment in my mind is this is very different, of course, for many reasons. This is not the COVID. But what's important is that this crisis started because of a massive destruction of international liquidity. So you can think that part of what happened here, this increase in money by the US and other advanced economies, kind of replace the debt assets partly generated by the shadow banking system. Whereas here, we have nothing of that sort. It's interesting that if you look at this with the eyes of general theory, of quantity theory of money, then you will start thinking that maybe 20% inflation is not that crazy. Maybe it could happen. Why not? Because at the end, if we go to normality, we have increased money like crazy, 20%. And that should at least put a lot of pressure on the market. Now, the comment for which I don't have time to show a slide is the instability. Another issue that Willem mentioned, the financial instability. And I'm very concerned about the Treasury, the US Treasury market, Treasury bonds. We've seen crises that we're not used to, like taper tantrum, like September 19, and so on. You can go on with that. So, and the treasuries are very important, and it looks like the US, that the Fed is very concerned by instability there. So I don't want to elaborate on this, but I can see the possibility that if inflation accelerates in the US and the Fed feels the kind of obligation to come forward and push on the brakes, that could destabilize the treasury market. And it may destabilize it also in the minds of the market, because what I have seen, and I think is a fact, in the recent treasury market blips, is that the Fed moves immediately forward to stabilize that market. So maybe an attempt to stop inflation can create instability in that market, in which case, for emerging markets in particular, I'm not so concerned about the US or advanced economy, but that kind of volatility could be very damaging for emerging markets. Thank you very much.
Thank you, Guillermo. So, so this is great. I love it when we have a panel where people don't agree. It's like the best. So I'm gonna, I have several very good questions in the Q&A that I'd like to get to, but let me take moderator's prerogative. I'm gonna start with a monetary policy question. Everybody talked a little bit about inflation. In particular, I am interested in everybody's view about the current inflation situation and inflation risks, which I think are pretty different, because Jack, at the ends, at opposite ends, there are Jack and Willem, I think, on this topic, at least with respect to the US. So in a very interesting coincidence of timing, both the Federal Reserve and the European Central Bank in the last couple of years have introduced new inflation targeting frameworks. Interestingly enough, the BOJ is not. In both cases, particularly for the Fed, they are substantially more flexible than the old systems. And if we're really concerned about inflation risks, both for the advanced economies themselves, but also the potentially very large spillovers, as Guillermo alluded to emerging markets. You know, I guess my question is, what do you think of the new monetary policy frameworks? Are they good ideas? Are they bad ideas? They haven't been tested. So by definition, there's a little learning by doing, but I'd be interested in the panelists' views.
Could I have a go?
Absolutely, go right ahead.
Well, I've just actually yesterday had an op-ed in the Financial Times about the Fed's new average inflation targeting framework, which I consider to be economic idiocy. It's a form of price level targeting. Economics teaches us that the price level is irrelevant. It's inflation and expected future inflation that matter, right? So this is simply a recipe for systematically overshooting the inflation target for a number of years, simply because you're politically impotent, because you're at the effective lower bound for many years, you have undershot the inflation target. Well, past errors, which you cannot do anything about, are no reason for making future errors that you can do something about. So I think the US framework is guaranteed to lead us to unnecessary periods of above target inflation. And we are there now, right? I think even if you look at core PCE inflation, the US is well above target. And that takes out all the noise in the gas and other commodity fields. So I really think the Fed is just behind the curve. They did absolutely the right thing, responding with infinite liquidity to the financial crunch in March 2020, right? They acted as lender of last resort, as market maker of last resort, and they should have. The balance sheet expansion entirely justified. That was then, this is now. It is time to tighten here, and with a bit of a lag, to start tightening in Europe and Japan as well.
I mean, I disagree, as you wouldn't be surprised to hear, Willem. I think it's important to remember that the Fed's new approach was not a response to COVID. It's something that developed over many years at a time when deflation was more the concern than inflation. And not just the United States, but Europe, Japan, most of the G7 was unable to see a pathway to getting to 2% sustained or stable or steady, whatever term you want to use, inflation. The simple arithmetic of shooting for a fixed target of 2%, in some ways, is an impossibility. You're never going to hit the target every point. You're going to have to be above and below it to average 2. So in a world where demographic pressures are driving down the workforce and demand is the problem, where we forget that before COVID, there was huge concern about, was demand permanently on a path where we weren't going to be able to hit a 2% target. In that world, the averaging made sense. I think if you looked at it as a response to COVID, I would probably be more in agreement with you. I think it's a mistake to reject the idea, because right now we're in a zero interest rate environment. And obviously, the challenge is, how do we avoid inflationary pressures with the supply shortages and the built up cash to fuel demand. It's kind of a moment in time. I don't think that the Fed is without tools to respond if they see that their targeting of averaging 2 starts to kind of bump up at 3. They can change that policy to bring it down. So they're not on autopilot. So I think we haven't seen a fair test of the approach.
If I may,
That's fine.
We are looking at 2 periods which are very different. The great financial crisis period, you saw always a shortage of liquidity out there, being very careful with that. And therefore, deflation was always a problem. But now we got a point where we increase money supply by 20%. So it's a different world. Having reached full employment, we have increased 20%. We just saw that without knowing that it related to COVID. One would kind of tremble and fear, gee, there is a source now for inflation. And if on top of that, you do that, and you look around and you laugh at the market and you say, hey, deal with this, because we will move, blah, blah, blah. That could be dangerous. You're creating a fire. I stop here.
So let me add a word on Bank of Japan and also inflation targeting in general. So Bank of Japan has failed to achieve 2% for many years, and even since that, the Prime Minister Abe appointed Mr. Kuroda and started this Abenomics aggressive monetary policy in 2013, that 2% has not been achieved. So is it a failure? Well, it may not be, because the real economy did really well. And GDP gap went to positive, and labor shortage and so on just before COVID struck Japan. And during this underachievement in inflation rate, but sort of overachievement in the real economy, Governor Kuroda said that he would allow overshooting. This is back in 2016, so a few years before the Chairman Powell mentioned this average inflation targeting, which is a very similar thing. You allow the overshooting, which means that you target the average 2%. And so average 2% is also, that's the stated goal in Australia. And I think this flexible inflation targeting framework is now moving toward this average 2%. The point is that, the inflation expectation is anchored at 2%. That's important. So, even if you go to 3% or 4% for several months, I wouldn't worry about it, provided that inflation expectation is anchored at 2%, which is, I would say, the case in the United States right now. So I think the Fed is trying to see whether supply constraints will be cleared so that prices will be coming down without taking drastic action on the interest rate hike and so on. So I support the Federal Reserve view, and also Bank of Japan, although Bank of Japan has a different problem of underachievement of 2%. We'll stop here.
Okay, thank you. So there are several questions in the Q&A about financial stability, and several of you brought it up. So I'm going to try to put some of these questions a little bit together, since we're running out of time. There were questions about in the chat, both about housing and financial stability, obviously the impact on emerging market debts, which several of you alluded to. And finally, a question, excuse me for a minute. I want to find it. And the biggest one, I think, which I believe Willem mentioned, non-financial businesses, which have been massively levered and have become even more levered because of COVID. So I'm interested in getting everybody's views about where do you think the potential biggest spillovers are. Real estate markets certainly are big, but the leverage in non-financial firms is very big. And we already talked about the sovereign risks. This is one of those financial stability exercises that I'm hesitant to ask, but I'm curious as to everyone's views. And also, what would be a potential policy responses if those financial stability risks are real, and we think that at least the advanced economies are going to start raising interest rates in the not too distant future? What do we think some of the policy choices are going to be? And you can pick advanced or emerging economies.
So I'll start. I think we have to take a different view depending on what countries we're talking about. And I think coming through COVID, we've actually seen financial systems hold up pretty well. So the reforms that came after the financial crisis, the better capitalization of financial institutions, more oversight, has in general proven to be pretty effective. I don't disagree that in a world of prolonged zero or negative real interest rates, the risk of bubbles grows. I think you have to look at them separately. For the emerging markets, I actually agree with Willem and others in assessing that as being an area of serious concern. It's not just a question of the amount of debt, it's the structure of the debt. And Willem made the point that Paris Club is going to be challenged because there's an awful lot of private debt in there. An awful lot of that private debt is semi-sovereign private debt. It's Belt and Road Initiative loans, for example, in many of those countries. This is going to take an international effort where the major economies come forward and actually look at what is the tail in the emerging economies, how slow are they to recover from COVID, what is the overhang of debt, and what is required in terms of traditional Paris Club and let's call it Paris Club Plus, so that the lending by China exceeds the lending by the United States in many of those countries. So it's not a small issue. Housing, there's no question, but the very low interest rates in the United States have contributed to housing prices being very high. One answer is supply, and I think you're going to see additional supply come if we invest in it, which is in one of the pieces of legislation moving through Congress. But that won't be the whole solution. That's going to be on the margin. There's going to have to be some kind of normalization. I haven't seen evidence that it's a financial stability risk yet. It may well be something that causes hardship for people in terms of their own personal balance sheets. But financial institutions are not in a place where they were before the financial crisis with the kind of complicated structured debt in housing that could collapse quickly. Non-financial debt it was an issue before COVID, and coming out, there will be some problems. Again, the question is, where's that debt held? How does it spread through the financial system? For years, I've said it's one of the areas where the need for greater scrutiny exists. We went through a period in the United States of not putting those issues through scrutiny. So I think we're a little bit in the dark as to where all of the debt sits and whether or not there's financial stability risk. But I think regulators do have tools to get behind that. And I think the time to look and ask the questions is before you have a problem, because you don't have time to figure it out. It could take a long time to figure out.
So one observation, I'll take moderators. So one observation is really interesting. The difference between Japan and Europe versus the United States. In the United States, it basically firms levered up. In Europe and in Japan, firms have basically got government guarantees effectively, either to retain their workers or on so is that going to end up in those jurisdictions in the financial stability risk is going to end up being on the sovereign? That's an interesting question, as opposed to in markets. We know in the United States where it is because it comes out as non-financial corporate debt, but I think there's potentially some big differences across countries. I don't know. Yes, Willem, were you going to say something? Or is that your
one reason the housing market is always a special source of trouble when it's booming is that it's leveraged, right? Now, when the tech bubble burst, we had a wealth effect. It was negative, but it did not cause a recession because it wasn't leveraged. This US housing market boom / bubble there is highly leveraged. And as and when it crashes, it will do more damage, I think, because of leverage, even though banks are indeed better capitalized than they were in the great financial crisis, although the same does not hold true for non-bank financial intermediaries. And of course, non-financial corporates themselves are highly indebted, and with again, their debts very generously priced in terms of risk premia by risk-loving markets. So I see the US as being particularly vulnerable on the debt side.
So Trish mentioned about the Japan. So Japan, I think there is a sort of two groups of corporations. One is large and also tech related, even large banks. They're doing well, and they have very little debt, and they have the excess savings, corporate savings are high. and only small and medium-sized sectors which are not particularly doing well under COVID, they may become zombie. And they have to figure out, the government has to figure out how to deal with it. But it will not pose any systemic crisis in the financial system. And that's the situation in Japan. And also in Asia, Southeast Asia, there are sovereign debt increasing, but still the foreign reserves are high, and debts are not necessarily denominated in foreign currencies. If the domestic debts, that they can deal with it. So there is no risk of sovereign default, like Asian currency crisis. It will not happen this time. I think the biggest question is China, and Chinese housing real estate sector, as we see every day on the headline, that is in trouble, and whether government will rescue them at the end or not, that's a big question, and we will see what will happen. And that's I would say that's the biggest question. So in addition to Jack's comments about the Chinese credits the liabilities of the developing countries, but China itself has this problem.
Yeah, I guess from the point of view of emerging market, I don't have much to add in this connection, but we don't have the institutions. I mean, the International Monetary Fund doesn't have funds which are big enough in order to solve these kinds of problems. So emerging markets are left by themselves, and I think it would be very important to develop, to have a discussion, at least at the academic level, about these issues, because we may be surprised by something which could look quite ugly, because emerging markets, many of them are not out of COVID by any means. So this could be a combination of a financial collapse with a crisis disaster. So I think that's something in my mind. It's true that they have an obsession with emerging market, but once you think about that, you cannot sleep very easily at night.
So I have to ask one more. I'm sorry. I realize I'm keeping us a little over, but because you just gave me a great lead into one of the questions that came in from the audience, which is about, isn't this finally about time to actually fix the international institutions for the modern world? Sorry, I'm paraphrasing that question. That was, they phrased it more politely and carefully than I just did. But it seems to me, Guillermo's comment, Willem and Jack's comments earlier about debt restructuring, is this the opportunity, or are we just going to need another crisis before we have a chance to actually?
Look, I think you saw an in-between response in the agreement to increase special drawing rights allocations at the IMF. And then in the further agreement amongst the largest countries, largest economies, to reallocate special drawing rights to the poorer countries. It actually had an exponential impact in terms of increasing the amount of borrowing capability of the smaller countries. I think it's quite important that happened without a huge amount of fanfare, without a lot of debate, and in terms of the US political system, without the need for a vote in Congress. There's as somebody who spent 5 years of my life getting the last quota reforms through the Congress, one has to just be realistic about how difficult it is to drive this kind of increase. So I give a lot of credit to the ingenuity behind the SDR moves. And in no way do I disagree with the underlying need to do more. I actually think it's something more along the lines of having a conversation about Paris Club Plus. That's probably the next step that would be a productive one, because there's going to be a need to have a bigger conversation in order for it to be effective.
Could I just make one point? in emerging markets and low-income developing countries, central banks often cannot act as crisis managers because the debt is foreign currency denominated. So access to swap facilities with the Fed, the ECB, the Bank of Japan, for a much larger number of emerging market and low-income developing country central bank is, I think, very important. Just so they can act as providers, even just of liquidity. The debt restructuring issues and the SDR allocations come on top of that. And I hope that this indeed quite surprisingly non-controversial $650 billion allocation is the first of more to come.
Yeah, so that in general, I agree. And I used to advocate right after the Asian currency crisis that the liquidity assistance is important, and IMF was too timid in giving credit loans to Asian countries. But since then, I had second thought, and for other countries, I think the liquidity crisis could be just a prelude to a sovereign crisis, or the liquidity crisis comes with sovereign crisis or insolvency crisis. And what if, heavily indebted country, which is not transparent about how much they owe to each country, ask for liquidity assistance from IMF? Should IMF give the liquidity assistance on top of those huge debt, which is not transparent? I think that's I think Jack was very diplomatic about it. But
and look, if one wants to put a sharper political edge on it, unless China is part of an agreement, there's the real risk that any kind of debt relief that comes through Paris Club or other international mechanisms ends up leaving the Chinese debt at 100%, while other debt is either eliminated or highly discounted. That's not a tenable outcome. So this is actually an issue that requires international cooperation before there's a crisis. It's not easy to work through.
And also to create a system that is not bound to have crisis. Because another problem is the politicians and the moral hazard and the combination of a corrupt politician with the financial industry, both maximizing, and at the end, sometimes when you look at the financial industry, it looks more like a drug peddler than a good contribution to the country's health. And once you create that condition, if you follow some negotiations with the fund and the bank, there is a tendency, not because the people are no good or corrupt, but there is a tendency to try to show that things work out, that to develop IMF programs that most economists look at them and say, well, this is not going to last. They will be revised. If you say so and you take it lightly, look what you're doing. You don't have any discipline. You could very well happen. I mean, I come from Argentina, so it's very easy to say. But you see that how it can develop, the disease can develop because you don't stop it. So that's also something that we should to look at the two sides, over indebtedness as this kind of systemic problem in several emerging markets.
Trish, could we go back and just talk maybe for a minute about the advisability of a balanced budget or a surplus at this moment?
Yeah, that was sorry, that's the one question of mine that I didn't ask because there were so many good questions in the chat. Where should fiscal policy be directed was the way I was going to phrase that question. Should we be balancing budgets? Should we be paying for them? We know there's going to be massive fiscal consolidation, right? There already is massive fiscal consolidation, even in the United States. But where should it turn now? It's no more cushion the blow income support stuff going on, at least not for the advanced economies and not for most emerging market economies too. So where should we be directing it? And you can include the balanced budget thing in there too.
I mean, I think that it's really critical to get out of the crisis mode. And to get out of the crisis mode, you start by paying for what you do before you do massive fiscal consolidation on top of that. I just don't think it's realistic to go right from the enormous deficits that were being run up during the crisis to try to pay it back in any short period of time. It's going to take a long time.
Yeah.
So balancing the budget quickly, I don't think is feasible. I would look at debt sustainability. I would look at targeting getting to primary balance as quickly as you can, which in a low interest rate environment is more achievable. And I would look at it as a long return, not a quick sudden one, because I at least in the US economy, I don't think there's either the economic or the political space to do it rapidly.
I think the answer is country specific, right? Clearly, almost so every country, possible exception of Russia, will have to have public sector consolidation if you take a long enough view. The speed at which you do it is driven by cyclical considerations. Where are we in the cycle? If the economy is steaming ahead, at risk of overheating, that's a good time to aim for budget surpluses. But clearly, you have to keep the cyclical considerations in mind when you select your long-term target. Some countries, I think, will have no choice. I mean, the Greeces of this world, especially. Japan, even though its sovereign debt is awesome, apparently can live with 240% of GDP without anybody paying attention to it. So the laws of economics have been suspended for at least a decade. Well, for that country, I don't understand it. But many emerging markets will be forced to consolidate at rates that are badly suboptimal because of the lack of availability of external financial sources and the dearth of domestic sources.
Yeah, so I need 1 hour to explain why the law of gravity doesn't work in Japan. But since I don't have a 1 hour, that simple answer is that it is worrisome. I don't think it's okay to keep 240% of GDP in government debt. Why we came here, it was 65% of GDP in 1990, the last year of the bubble. And we thought this is a recession downturn, so counter-cyclical fiscal policy is justified and increasing and never ending. Stagnation never ended. So it kept going and going and going, and spiked by banking crisis 1997 and the global financial crisis 2008, 9, and now the COVID. So gradual reduction in new issues it didn't go to zero before another crisis came. So that's why we have 240%. But I really worry about it.
And it wouldn't work in every country because your domestically held debt makes it sustainable in a way that it wouldn't be in other countries.
Including the United States.
Including the United States, yeah, where it's half and half.
Exactly. All right, now we're really over time. Thank you all very much. This was great. I'm so glad that at least some folks could stick around where we went a little over time. Thank you again. I'm afraid to be continued is probably my best guess. At some point, we're going to end up having to come back and have this debate again. Thank you all. Have a good day.